Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It is good to be here.
Today is Monday, February 16th, 2026. And I have to say, looking at the screens this morning, the vibe is it's strange. Usually we have this mental model of how the world works. Safe places are safe, risky places are risky. But lately, the market is looking at that textbook and just tossing it right out the window.
It really is.
We're seeing things that, honestly, they shouldn't be happening.
No, if you're still trading based on the rules from, say, 2020 or even 2024, you are probably scratching your head right now.
Right.
But when you dig into the recent data,
Yeah.
there are these fascinating, almost contradictory patterns emerging.
And that is our theme for today, market anomalies. We're breaking down 3 stories that just flip the script. First, we're looking at emerging markets. Usually that is the roller coaster ride of the portfolio, right? High stress. But right now, they are the calmest room in the house. With the big, rich economies, they're the ones making all the noise.
It's a complete inversion of volatility.
Yeah.
The so-called risky bets are acting like savings accounts. It's wild.
Then we have this plot twist in the auto industry. We have President Trump in the White House, trade tensions are high, yet we're hearing these rumors of a loophole that might actually put Chinese electric vehicles on American roads.
It sounds impossible.
It does, but the details are wild. And finally, we're going to Australia. Why is everyone suddenly trying to build the internet's engine room down under? And is it a sign that the AI bubble is about to pop?
Or conversely, is it a sign that the physical constraints of AI, power and water are finally hitting home?
We are going to get into all of that. And look, I know some of you listening manage millions and some of you are just trying to figure out your 401k. We are going to skip the jargon today.
Okay.
No quantitative easing lectures. We just want to know what is happening and why does it matter to our money?
Sounds like a plan.
So let's start with this first anomaly. Emerging markets, or EM. When I think of EM, Brazil, Turkey, Southeast Asia, I think of high growth, but also high stress.
Yeah, currency crashes, political drama.
Exactly. And when I think of the G7, the US, Europe, Japan, I think of safety. But looking at the volatility charts you pulled, the lines are crossed.
They have crossed and they have stayed crossed. According to the data we're seeing, for nearly 200 days now.
200 days.
Nearly 200 days. Currencies in emerging markets have been less volatile than the currencies in the G7.
Wow. Okay, so that isn't just a weird week. That is a trend.
It's a regime change. We call it the stability anomaly. Think about it. Usually, if there's a crisis, investors dump the Mexican peso or the Brazilian real, and they run to the U.S. dollar.
Or the flight to safety.
But right now, the uncertainty is coming from the top. We have questions about U.S. interest rates. We have policy shifts in Europe. The safe suburbs are noisy, while the Wild West is, it's quiet.
So the neighbors in the gated community are fighting on the lawn, and the folks in the supposedly rough neighborhood are just quietly mowing the grass. Why? What is keeping them so stable?
There are a few mechanics at play, but the big one is the carry trade.
Okay, the carry trade. I see this term thrown around constantly. I know the basic concept is, barter cheap, invest high. But walk me through the danger here. Because usually when something sounds like free money, there's a catch.
There is always a catch.
Yeah.
So here's the setup. You go to a country like Japan or Switzerland where interest rates are rock bottom. I mean, basically zero.
Okay.
You borrow a bunch of money there. Then you take that cash, you convert it, and you put it into a bond in, say, Mexico or India, where they might pay you 10 or 11% interest.
So I'm paying 0 interest on the loan, and I'm earning 10% on the investment. I just pocket the difference.
Correct. And because so much global capital is doing this right now to chase those yields, money is just flooding into these emerging markets, that constant demand. It keeps their currencies stable. It suppresses the volatility.
Okay, but here is where I get nervous. I'm borrowing in Japanese yen to buy Mexican pesos. What happens if the yen suddenly gets expensive?
That is the killer risk, and that's why this stability is so fragile. If the currency you borrowed, the funding currency, goes up in value, your debt effectively gets bigger. You might be earning 10% interest, but if your loan principal jumps 15% overnight because of exchange rates, you're wiped out.
So it works until it doesn't.
And right now, it is working because the U.S. dollar has been relatively weak against the euro and the yuan for about a year now.
And a weak dollar is good for them.
A weak dollar acts like a sedative for the global market. It makes it easier for these emerging countries to pay their dollar-denominated debts. It takes the pressure off.
But is this just a trick of the light, or have these countries actually, fixed their economies? Because I remember the late 90s, the Asian financial crisis. Those economies collapsed like a house of cards.
Well, that's the it's different this time argument.
Which is always a dangerous phrase.
It is, but there's some merit to it. The Financial Times had a great analysis on this recently. Since 1998, Asian countries specifically have built massive buffers. They have stockpiled foreign reserves. They are not running on empty anymore.
So they actually have a savings account now.
A big one. In fact, look at Singapore. The Singapore dollar, the SGD, traders are starting to talk about it the way they used to talk about the Swiss franc or gold.
Wait, Singapore is a safe haven now. Like, World War III is starting. Buy Singapore dollars.
Increasingly, yes. Strategists are pointing this out. In a world where the U.S. and Europe are dealing with inflation and deficits, Singapore looks incredibly well managed. It's becoming a vault. And that is a massive psychological shift for investors.
That is huge. But we have to look at the other side. You mentioned the dollar is sedated. What wakes it up? Because if the U.S. economy heats up, doesn't the Fed raise rates?
That's the risk on the horizon. We are all watching this AI boom in the U.S. If that technology starts driving real massive productivity gains, making American companies way more profitable.
Money rushes back home.
Money is going to rush back into the U.S. dollar.
And if the dollar surges,
the carry trade explodes. The quiet in emerging markets ends instantly. So enjoy the calm, but, keep your hand near the exit.
It's quiet, but it's a crowded room. Okay, speaking of quiet deals that might explode, let's look at our second anomaly. This connects perfectly because while the financial markets are finding stability in strange places, the geopolitical world is finding cooperation in strange places.
Which brings us to EVs.
Right. We're in 2026. President Trump is in charge. The narrative is America first, tariffs, trade walls against China. But then Bloomberg Law drops this report about joint ventures. It sounds like a backdoor.
It's a potential pragmatism born out of necessity. The rumor is that the administration is exploring a framework to let Chinese EV giants companies like BYD partner with U.S. firms to manufacture cars on American soil.
Okay, but I thought the whole point was to keep Chinese cars out to protect Detroit.
The goal is to protect Detroit's business, but the reality is that Chinese battery tech is years ahead and significantly cheaper. So the proposal is a controlled opening.
Explain how that works. Is it like a 50-50 split?
No.
Yeah.
And that is the key. The condition is that the U.S. partner must hold the controlling stake.
So let's use an analogy. It's like owning a restaurant. I'm the American owner. I hire a world-famous chef from China. He brings his secret recipes, his special ingredients, and he cooks the food. But I own the building, I run the cash register, and I decide what goes on the menu.
That is it. You get the quality product at a lower cost, but you keep the profits and the control. The U.S. gets the cheap batteries and the manufacturing jobs, and the Chinese company gets access to the American consumer.
Which sounds great for a car buyer. If I can get a high-tech EV for $25,000 instead of $45,000, I'm listening. But politically, this seems messy.
It is incredibly messy, and we're seeing signs of a massive internal fight in Washington about this. Did you see what happened with the 1260H list on February 13th?
Yeah, this was bizarre. The 1260H list, that's the blacklist for companies linked to the Chinese military.
Right. If you are on that list, you are toxic. So on February 13th, the Pentagon updates the list. They add BYD and Alibaba. Huge news.
The market must have tanked.
For about an hour. Because 60 minutes later, they retracted it. They took the names off.
Wait, they deleted it? Was it a typo?
You don't make typos like that at the Pentagon. This wasn't a glitch. It was a signal of regime uncertainty. It tells us there is a tug of war happening. You have the security hawks who want to ban everything Chinese, and you have the deal makers who want this joint venture model to work because they know it fights inflation.
So the government is fighting with itself. One hand adds them to the blacklist, the other hand erases it.
Correct. And markets hate that kind of confusion. But the clock is ticking. President Trump is planning to meet President Xi in Beijing in early April.
The summit.
Exactly. Markets are betting that this joint venture idea is the deal Trump wants to announce. I brought the jobs back, I lowered car prices, and I stayed tough on China. I mean, it fits his style.
But what if the hawks win? What if the answer is just no, stay out?
They have the Mexico backdoor. BYD and Geely are already looking at buying factories in Mexico. If they build there, they can ship cars into the U.S.
So either they come in through the front door with an American partner, or they come in through the side door from Mexico.
And that is the dilemma for Ford and GM. Do you partner with them and survive, or do you try to fight them and potentially lose on price?
It's a fascinating pivot. We go from block China to managed China. Okay, let's slide to our final topic. We've talked about where money is flowing, where cars are being built, and now let's talk about where the internet actually lives.
The physical reality of the cloud, yes.
We are heading to Australia. Now, I love Australia: beaches, mining, kangaroos. But I don't usually think of it as the center of the tech universe. Yet recent reports show a massive boom in data center construction down there.
A huge boom.
Why Australia?
It comes down to two things: space and power. We are reaching a crisis point in the traditional hubs. Northern Virginia, Frankfurt, Dublin. These places are full.
When you say full, what do you mean? We ran out of land.
We ran out of electricity.
Yeah.
The grid cannot handle any more connection requests. You have tech companies ready to spend billions on AI servers, and the local power utility says, take a number, we can hook you up in 2029.
Wow. So the bottleneck isn't the fancy AI chips, it's just plugging them in.
Precisely. So capital is flowing to places that still have grid capacity. Australia has land, stability, and energy resources. So the hyperscalers, the Googles and Microsofts of the world, are rushing there.
But I read this note from analyst Mark Cranfield, and he called this a reverse indicator. He thinks this is a bad sign.
It is a contrarian take. His argument is that if you are building data centers in Australia, which is physically very far from the biggest user bases in the US and Europe, it means you are desperate.
It's like the real estate market, right? When people start flipping houses 3 hours outside the city because the city's too expensive, the bubble is close to popping.
That is the analogy. He's asking, are we just scraping the bottom of the barrel for locations? If the prime spots are gone and we're throwing money at secondary locations, maybe the demand is overheated.
Is he right? Is Australia just the overflow lot?
I don't think it is just overflow.
Yeah.
There is a real demand for what's called data sovereignty. Asian countries want their data stored in the region, not in California. And for AI to work fast in Asia, you need the servers close by to reduce lag. So Australia makes sense as a regional hub.
But even Australia has limits, right? I mean, it's a continent, but it's a dry one.
That is the elephant in the room.
Yeah.
Water.
Yeah.
We talk about AI clouds, which sounds light and fluffy. But physically, these data centers are hot industrial factories. They need millions of gallons of water for cooling.
And Australia isn't exactly known for having extra water lying around.
No. In Sydney, there are already fights breaking out between local communities and tech companies over water usage. And the grid there is starting to creak, too. It turns out, there's no such thing as infinite infrastructure.
Which brings us to the investment angle. If the land is running out and the power is running out, where is the smart money going?
It's the picks and shovel strategy. Don't just buy the data center REITs. Those are crowded. Look at the supply chain for the grid.
The stuff that makes the electricity work.
Transformers, high-voltage cables, grid management software. Whether the data center is in Virginia or Sydney, it needs copper. It needs cooling systems. It needs power regulation. The bottleneck is the opportunity.
I love that. Don't buy the AI chip, buy the copper wire it plugs into.
That is where the durability is.
Okay, we have covered some serious ground today. Let's recap for everyone driving to work right now. First, emerging markets. They are suspiciously quiet. The stability anomaly is real, but it is built on a carry trade that relies on a weak dollar. If the U.S. economy flexes its muscles again, that trade could unwind fast.
Watch the dollar. That's your signal.
Second, EVs. The trade war is shifting. We're looking at controlled openings, where Chinese tech might power American-made cars. It's a way to fight inflation, but it requires the U.S. government to stop fighting with itself first.
And keep an eye on April. That Trump-Xi meeting could change the auto industry overnight.
And finally, Australia. The data center boom proves that the physical world, water and electricity, is the ultimate speed limit for AI.
The digital revolution needs physical resources. That is the constraint.
So before we sign off, I want to leave our listeners with a thought. You mentioned something earlier about the U.S. automakers entering these joint ventures.
Yes.
It really struck me. If Ford or GM enter these deals, they get cheap batteries and they survive today. But here's the question. If you're just assembling someone else's technology because you can't figure out how to make it cheap enough yourself, do you lose your soul?
It is the ultimate risk.
Yeah.
You might save the balance sheet, but you hollow out your innovation. If 5 years from now, the U.S. auto industry is just a wrapper for Chinese engineering, have we really won?
That is a heavy question. Are we renting our own future? Something to think about.
Indeed.
That is all for today's deep dive. We hope this helped you see through the fog.
Thanks for listening.
Don't forget to subscribe and hit that like button. We'll see you next time on Investment Insight.